Hi everyone, welcome back to another lesson in 2306 Texas Government. Today we are going to be talking about taxing and budgeting. So we will talk about types of taxes to begin with. Of course, we are going to start with the national taxes. In 1913, the United States added the 16th Amendment to the Constitution. Now, the 16th Amendment is the Income Tax Amendment. This amendment allows individual and corporate income taxes to immediately become the national government's major source of funding, and today constitutes approximately 60% of federal tax revenues. This, of course, leads to state taxes. Texas used to rely on property tax for its main source of income. Property values declined during the Great Depression, though, so the state had to look for other ways to have income. In the 1930s, Texas started taxing cigarettes, beer, and distilled spirits. In 1961, Texas adopted a general sales tax on most items sold. Now, a general sales tax is a broad-based tax which is collected on the retail price of most items. There are, however, exemptions, and in Texas these exemptions include food items, not fast food or snack food, meaning anything that is prepackaged, medicine, baby supplies, but not diapers, newspapers, and 1 weekend a year, of course, there are school supplies. Now, selective sales tax. This is also known as an excise tax. Now, excise taxes or selective sales taxes are levied, meaning they are placed on the sale, manufacture, or use of particular items, such as liquor, cigarettes, and gasoline. However, these taxes are usually included in the item's purchase price, so it is often thought of as a hidden tax. Now, there are two others that should be placed under here. That is the gross receipts tax, and these are taxes on the total gross revenue or sales of certain enterprises. Also, the severance tax. It is a tax on raw materials such as oil and natural gas when they are extracted from their natural state. So this is a tax that's placed on these materials as they come out of the ground. Now, local taxes. Most localities rely on property taxes for their major source of funding. These are ad valorem taxes, which is a tax assessed according to the value of the item. This can be a tax on real property and personal property. Now, real property would be considered as lands and buildings, while personal property would be such items as furniture and automobiles. Now, to come up with an estimated worth, each county in Texas has a central appraisal district which values property according to uniform state standards and procedures. When you get your yearly tax appraisal, you can file a protest and go in front of a board at the Central Appraisal District and explain why you think the property is not worth what the appraisal district states it is worth. There are also exemptions you can take to decrease the tax liability of real property. These can include homeowners exemptions, agriculture exemptions, and exemptions for people over 65. Now, cities with a certain population can also impose a local sales tax on all items the state imposes a sales tax on. So you are being charged by both the local entity, meaning the city or town, and then the state. Special districts. When we talk about taxes, we also have to include special districts which can impose taxes. These special districts are those agencies such as school districts, mass transit, and municipal utility districts, which are also called MUDs or pub MUDs, which are utility districts that charge you for water and sewer when you are out of the city limits and you are not eligible for city water. Now keep in mind that the most common single source of revenue for the state taxes are consumer taxes, which are sales tax and excise tax. Because of high sales taxes, most of the taxes in Texas are paid by the consumers and not businesses. Business taxes are limited, taking the form of corporate franchise taxes. Now, the politics of taxation. What do we tax? Raising or losing money is simply as easy as raising or lowering a tax rate, the amount per unit of taxable item or activity. But to do that, we have to have a tax base. And the tax base is simply the object or activity that is being taxed. But what is the problem with having your taxes fixed like this, where you tax certain objects at a fixed rate? Excessive taxes. Excessive taxes can change a person's or a business activities. If you raise taxes on cigarettes or alcohol with the expectation of making more money, what happens if you raise the tax too high and people quit smoking or drinking? In other words, quit using these items. If you raise property taxes too high, will people be willing to move to this new area? Will they even be willing to do general maintenance on their homes and keep the value up? At a certain point, you have to ask, are the taxes in my area too high for me to afford to live in this neighborhood? In order to raise taxes, the tax rate must be low enough that it will not discourage consumers from participating in the activity you want to tax. In other words, you have to keep the tax rate at such a low state that you can still make money as the state wants to, but you can also let people afford to purchase the items that are being taxed or to be able to afford a home. Now, there are broad-based taxes. Most governments have discovered the best way to tax is through a broad-based tax system. This means there is a relatively low tax rate on many items or activities. This does not discourage people from using those items or activities, and thus the tax is paid by a larger number of people. Whom or why do we tax? So there are three common rationales for taxing various groups. The first is because the government wants to regulate behavior. The second is to tax people according to the benefits they receive. And third is to tax people according to their ability to pay. So this brings us to regulatory taxes. Regulatory taxes are also sometimes called sin taxes. It is a tax imposed with the intent of exerting social or economic control by reducing taxes on approved behaviors or imposing higher taxes on undesirable activities. Now stop and think. Can you think of some examples right off? Texas has a sin tax on cigarettes, alcohol, and there's actually a tax charged for admissions to sexually oriented business. This tax is supposed to go to support a domestic violence fund. Now, these taxes do not entirely prevent sin or prevent you from your vices, but they do place a substantial share of the tax burden on the sinner, or in other words, on the person who is buying cigarettes or buying alcohol or going to these sexually oriented businesses. Notice the name of these taxes is regulatory. what the government is trying to do is regulate your behavior. If you are going to smoke or drink, then you will pay a price for that. Now, when it comes to benefits received taxes, this is a tax assessed according to the service received by the payers, by the taxpayers. An example of this is the fuel tax. The attitude is that the amount of fuel used should represent the benefits from highway building and maintenance. If you are using more fuel, you are then using the roads more often, so you should have a higher share of the cost than those who use it less often. Another example would be those who purchase hunting or fishing licenses. They pay more money into the wildlife management system than those who do not hunt or fish. This would seem logical, but is it really? What about the people who will drive to the state parks for a day hiking trip or to the beach at the state park? They pay to get in, but don't have to buy a permit. Also, if you are purchasing a hunting or fishing license, most of this can be done on private property, which you are already paying taxes on. Now, another benefit or another example of a benefits received tax, though not an actual tax, is school tuition. It is assumed the more education you receive, the more money you will make. The individual will be making more money, so shouldn't they pay more since they will be receiving the benefit of that education? Now, do you see any problems with this? The state will make more money from taxes because you will have more money to spend based on your employment from the education you received. So y'all stop and consider what you guys are doing coming to school, right? The idea behind it is you pay your tuition, which goes to the state. Your tuition then affords you to get a better job, in which case you are making hopefully more money and you are able to spend more of that money. But do you really? Should that be the rationale? Just because you have more money, are you going to spend more money? And the deal is, if you spend more money, then you are paying more in taxes, or that is what the assumption is, right? Next is the ability to pay taxes. So these types of taxes are those taxes that are apportioned according to taxpayer financial capacity. In other words, how much can you pay? These types of taxes are property taxes, sales taxes, and income taxes. If you are able to afford more valuable property, you should be able to afford to pay a higher tax. If you have more money to spend on miscellaneous items, you should pay more in sales tax. If you have a higher income, you should be able to offset paying more in taxes because of the higher income. That is what we talk about, or what we are referring to when we mention ability to pay taxes. Now, when it comes to tax rates, there are two different types of tax rates. The first is the progressive. A progressive tax rate is a tax rate that increases as your income increases. We see this with the federal income tax. The more money you make, the higher your tax rate will be. Regressive, on the other side, though, is a tax rate that places more of a burden on low and middle income taxpayers than on wealthier ones. Examples of these are sales taxes and most other consumption-based taxes. Now, as you can see on this slide here, we have examples of tax rates. If you will look on the left hand side, you will see the different examples of your taxable income, and you will see by the color codes and the tax rates that the less money you make, you are being charged less in income, right? So the more money you make, the more you pay in taxes. This is a progressive example. Examples of progressive tax rates. Now here you have an example of, regressive, right? You are taxable income of $1 million, but yet we are only asking you to pay 0.2%, right, on your taxable. We're only going to percentage of your taxable income is going to be 0.2%. And this is the argument that those that make less are the ones getting taxed the most. So these two charts, this one and the one previous, are just for information purposes, just so that you can see the first one is a progressive tax and this is more of an example of a regressive tax, where those with the highest taxable income are only being taxed on a lower percentage of their income tax, or of their actual income received. So we'll continue with tax rates, talking about those. When we consider tax rates, we have to consider that there is a declining marginal propensity to consume, meaning that as consumers, each one of us will actually spend less the more money we make. The tendency is that as income increases, for persons, for you and I, to devote a smaller portion of our income to consumer spending and a larger portion to savings or interest. So is this true? Remember, we are discussing proportions of income. If you make $20,000 a year and drink a 12-pack of Coke a day, if I make $100,000 a year, I would have to drink 60 Cokes a day for it to equal out. Does this happen? Well, no, of course not. If you drink 12 Cokes a day and pay $5 in taxes, and I drink 12 Cokes a day and pay $5 in taxes, who is paying the higher percentage of their incomes to sales tax? If you are the person making 20,000 or the person making 100,000. The understanding behind this is that as we make more money, we are going to want to not spend our money. We will actually save more money. This is the adage behind the rich get richer, right? The rich don't spend their money. They spend other people's money. At least that's the thinking, right? They borrow or they get a line of credit, but they are not spending their own individual money. So as you make more money, the thinking is that you are going to want to save that money. You are going to want to invest that money, so you will not actually be spending it on consumables. Tax shifting. Do businesses pay taxes? Yes, they do pay taxes. Well, they pay them. Do they pay them, or are the taxes passed on to the consumer? While businesses do pay taxes, these costs are shifted to the consumer in the form of higher prices. Now the next consideration is supply side economics. So should we have a regressive or progressive tax rate? Supply side economics is a theory which states that higher income taxpayers should be taxed less because their savings and investments stimulate the economy. Plus, sales and property taxes are easier to collect, harder to evade or avoid, and are generally less burdensome than progressive income taxes. But who are they less burdensome to? There are some who want there to be a national sales tax, and thus we would do away with the progressive federal income tax. But would this actually be a good idea? Remember, how many of us, if we could afford to spend money, actually would spend our money? Now there are other non-tax revenues for the state. States also get money from the federal government. These usually come in the form of grants. Now the first grant type is a categorical grant. A categorical grant is federal aid that is given to the state or local government for specific purposes. These types of grants are given under restrictive conditions and often require matching funds from the receiving government. Remember, these types of grants are usually for a specific purpose. Now, block grants. During President Reagan and President Nixon's administrations, they wanted to give the states more power in how they spent federal money. So both Reagan and Nixon increased the use of block grants. Now, block grants are federal grants that are given to the states or local governments for more general purposes and have fewer restrictions. Unlike the categorical grants. Remember, categorical grants are for a specific purpose and often require matching funds. Block grants are very general purpose and few restrictions. Now, the advantage of block grants is that states or local governments get to determine the best way to spend the money. However, there is less accountability with how the money is spent. Now, devolution. Devolution is an attempt to enhance the power of state or local governments at the expense of the federal government. In other words, the power devolves. It goes down per layer of government. So the federal government states we have the power, but we are going to step aside and let the state or local governments handle the issue. So the lower the power is shifted, then you are devolving that power. So you have all the power of the federal government, it dilutes when it gets to the state government, and then it will devolve even more by the time it gets to the lower local level. Now, when it comes to borrowing and other revenues, we are going to talk about general obligation bonds. General obligation bonds are bonds to be repaid from general taxes and other revenues. Such bond issues usually must be approved by the voters. Now, revenue bonds. Revenue bonds are those bonds that are going to be repaid with revenues from the projects that they will finance. These can be utilities, hotels, sports stadiums, and arenas. Now, other revenues. These can be income from lotteries, various licenses, fines, fees, dividends from investments, and the sale and leasing of public lands. Now, the budgetary process. When it comes to budgeting, there is incremental budgeting. During incremental budgeting, this is where we are basing an agency's budget request on past appropriations, plus increases to cover inflation and increased demand for their services. We are assuming when we use incremental budgeting that the past appropriations, meaning their past budgets, justify current budget requests. So in this instance, the agency or the department will get money based on what they have previously requested and add appropriate money for inflation and increased demands. Zero-based budgeting, though, is where we are taking a budget request and evaluating it as if the program or department was a brand new startup program, and it is not based on past levels of funding. So each agency that is using a zero-based budgeting basically starts at zero every budget cycle. Nothing is taken into consideration as to how much was spent in the past. And of course, appropriations. Appropriations is the process by which a legislative body legally authorizes a government to spend specific sums of money to provide for various programs and services. I have used this term before. It is when the legislature approves the process and the money for departments and agencies. It is the legislature that is going to be the bank. I keep saying this. They are the ones that hold the money. It is up to the legislature to decide what is the appropriate amount of money to fund each and individual programs and departments. Now, the politics of state spending. Consider that there are issues that will come along and things that you will have to do as a legislator in order to get funding. Log rolling. Log rolling is simply the trading of votes among legislators, especially when there is going to be a vote to fund local projects to benefit certain districts. Now consider why you would need this trading of votes. Remember, if you get the support of other legislators, then when the time comes and those other legislators need your support, you will then have to return the favor. And of course, there are dedicated funds. These are revenues dedicated for a specific purpose by the Constitution or by statute, meaning by law. This means that Congress has enacted a law that requires funds for a specific purpose. An example of this, well, 3/4, consider that 3/4, 75% of the motor fuel tax goes to the Texas Department of Transportation. So 3/4 of the taxes that is charged on every gallon of fuel that you pump, 3/4 of that will go to the Texas Department of Transportation. And that brings us to the end of taxing and budgeting as it pertains to the state of Texas. If you have any questions, of course, as always, email me. I will be happy to answer any questions or elaborate on any specific concerns that you have about taxing and budgeting. Otherwise, y'all take care, and I will talk to y'all again. Thanks.